Everybody, welcome to a brand new episode of MFIS TV. Today, we're going to be talking about how is the correct way to cash out on cashing out when you're buying a home out of your 401k plan. It's a common question. People are very interested, especially right now with the cost of housing. So there's a couple of ways you can cash out your 401k plan and IRA. And the first way you can cash out your IRA or your 401k plan is, or your retirement account, we should say, is with your IRA or Roth IRA. We could take out, if you're a first-time home buyer, so when we buy a first-time home buyer, that means you have not had your name or title of a loan for the last 3 years. Now, with that being said, if you're a person who qualifies for a regular IRA, traditional IRA, or Roth IRA, you could pull out $10,000 out of your retirement account for your first home, for your down payment. Now, if you're a person who is beyond it, this might be your second or third house or be having a title, you're not qualified for this. But for your first house with an IRA or a Roth IRA, you can pull out $10,000 on your first home. The second thing you do is you could cash out your 401k plan. Now, the problem with cashing out your 401k plan is with the first one, when you pull out $10,000, if it's a traditional IRA, we're going to have to pay $10,000 on that dollars. If it's a Roth IRA, that money's going to be tax-free. But if we cash out our 401k plan, we're going to have to pay taxes plus penalty if we're below 59.5, which I'm assuming most of the time when people are looking at this video is going to be below 59.5. So let's look at this. You say, hey, let me put down 100,000, put down the 20% that they asked me to because I want to buy a $500,000 house. So let's look at a quick look at that. I'm pulling out 100,000 out of my account. And the tax rate for federal is going to be on top. It might even possibly increase our taxes that we normally pay. So if we make $50,000 a year, that year we're going to show $150,000 a year, and it could put us in a higher tax bracket. But let's say we're going to pay 22%. We're in the 22% tax bracket for feds. Also, we're going to have to pay 10% penalty because we're below under 59.5. Now, if you're in a state that charges no state income taxes, this is all you pay. But here in California, we're going to still have to pay some more in taxes because we're in a high tax state. So California, New York, but certain states like Texas, Nevada, Florida, where there's no state income taxes, you don't have to worry about that. But let's say you're in California, you're going to have to still pay another 9.3% for state and another 2%. And then another 2% for a state penalty as well. Everybody wants your money. So if we say 100,000, if we add this to 22 plus another 10, that's 32%. And then we say 41, that's $43,000 we're going to pay in taxes on our 103,000. So we're only going to take home 57,000 if we cash out our 401k plan to pay for our first house, which is a big major tax killer for this. And it could put our regular 50,000, our regular ordinary income we make, in a lot higher tax bracket. So this is something I do not highly recommend that we do not do, because I don't think this really benefits us to pay this much in taxes on our home out of our retirement account. Now, your third option you could do, which might be the most popular way that people look at how they take money out of, is not with your IRA, but with your 401k plan. And what we can do with our 401k plan, if you could be a first-time home buyer, you could be having a home for thousands and thousands of years, hundreds of years, is what we could do is we could borrow out of our account. And we could borrow half of the account up to $50,000. Now, when we borrow this $50,000 out of the account, we are borrowing the money. So we pay no taxes on those funds when we do borrow. And when we borrow this $50,000, we have up to 5 years to pay it back. But before you pay it back, what you want to do is, and before to confirm this 5 years, it really depends on your 401k plan administrator. So you want to confirm this before you figure out that 5 years is 5 years. Some plans might be 3, but for the most part, it's 5 years. And so what you do is every time you get a paycheck, you're going to pay a portion of these funds out of the $50,000 over a 5-year period back into your own 401k plan. So let's look at it. You borrow $50,000. Your monthly payment back is going to be $483 on average a month. The interest that they charge you is going to go back into your into your 401k plan. But the problem is the interest that you pay is going to be taxed on it. The principal that you pay back of the $50,000 won't, but the interest that you have will be. And the great thing about this is the interest rate that you do borrow is very, very low. But here's the downfall. Let's say you leave your job. Let's say you get laid off. If any of those things happen, you have 90 days to pay back those funds. Now you might be saying, Jason, what happened if 90 days I don't have the $50,000 to pay back, or the 25 grand, or how much ever I bet? Now this amount that you borrow, whatever the remaining balance, we're going to have to pay ordinary income taxes on that money. We're going to go back to get paid a penalty for that, just like it would if we cash our 401k plan. So what I always recommend is, if we're doing this for our home, is that we should really consider if our job is stable. Are we going to plan on being there? Do we love our job before we make this type of move? Because if not, we could put ourselves in a very bad tax situation. If we use all this money now, we take out this $50,000, we switch jobs, and now, hey, we had to pay it back, but now we spent all our money. How are we going to pay this tax bill now? And this tax bill could be very, very expensive. Now, let's say, hey, you know what, Jason, I already got my house. Now I'm looking at I want to use this property for investment purposes. Now, if you're using for investment purposes, there's another sound strategy we could do, which is what we call a self-directed IRA. And what a self-directed IRA does is if we buy an investment property, it could be a house. It could be a house. It could be a house. It could be an apartment. It could be any type of investment vehicle. We could use our IRA to buy this house, as long as we make this an investment property, which means this house right here, it cannot be in your name, your kids' names, your parents' names, or any close family members. And what this does is all rents that we collect have to go back into the IRA until we're 59 and a half. Now, this is great for somebody who has a lot of money in your 401k plan, into your IRA accounts, and you're trying to figure out, hey, I want to buy some investment property, but I don't have the money sitting in the bank. This could be a great option for you. But you have to make sure you talk to somebody about doing your self-directed IRA. Keep great records, because if you don't keep great records for this, this could be a huge tax nightmare for you. With that being said, here's some great options for you about what you should do with your 401k plan, with your IRA when you're buying your home. Anyways, if you have any more questions, make sure you give us a call, 510-229-7608, and make sure you hit the subscribe button, and we'd love to help you with that. Have a good day. Please give us some more topics you'd like to hear